Will.
Okay, so
Thank you, Dr. Brown. I appreciate it.
Thank you, everybody, for a few minutes today, and it's great to be back in Gainesville and on campus, and go Gators. I see one of my teammates that just walked in the back of the room, Scott Axelrod, who is one of our corporate bankers at Raymond James Bank, who just enrolled in the MBA program here and started this week. I know, Scott, you're going to be up here for the next year or so? Yeah, so he'll be on campus, and you'll have to seek him out. He's a Gator, also undergrad, so, and recent CFA graduate as well. So, like I said, it's great to be back on campus and spend some time with some Gators. As Dr. Brown mentioned, I did go to school here. I graduated in 1988, undergrad, and got my MBA in 1999. And I have been in the banking business. I don't know why sometimes I scratch my head, but I've been in the banking business since 1988. It's funny, I've got a kind of an embarrassing confession that I need to tell you about. You get asked after a few years, why'd you go to work for that company, or how'd you get in the banking business? And it always sounds good that I wanted to apply some of the skills that I learned here at the University of Florida, incredible corporate finance skills, and it seemed like a great training program at one of the predecessors to Bank of America that I went to work for. None of those are really the reason I got into banking. Actually, in the, I guess it was spring of '88, going through the normal career fair, I know some folks are out and about looking for summer internships and permanent placements if you're about to graduate. I needed a job. I didn't have any money. I needed a job first and foremost. Maybe some of you can relate to that. It's amazing. I can't even look at a box of Kraft macaroni and cheese anymore. I had enough of that when I was in college. But the real reason I went to work for, once again, NCMB National Bank, that was based in Charlotte, North Carolina, which was really the predecessor organization of Bank of America, had just come into Florida a few years prior to that, and they were recruiting a lot of University of Florida graduates. And the very first person that I met at career fair, no, let me back. It was the spring of '88, and one of my classmates, we were taking the capstone finance class in the spring of '88, she had already gotten a job offer from this company earlier in the fall. She was the 1987 homecoming queen here at University of Florida. Her maiden name is Dignam. Patty Dignam was 87 homecoming queen here. One of the top graduates in the College of Business, and she was a friend of mine, and she had this job offer. I went to the career fair, and the first person I met was a lady by the name of Susan Barber. It's now Susan Merrill's her married name, and Susan was the 1985 University of Florida homecoming queen. And so, great lady, go Gators, and set me up for my first interview. And my first interview here on the campus a couple of weeks later was with a lady by the name of Taryn Few. Her married name is Taryn McKay now, and she was the 1980 University of Florida homecoming queen. And I'm like, this. If it's good enough for these three ladies, it's certainly good enough for me. And it must have been a very poor recruiting year, because they made me an offer, and that kind of started a career of impeccable negotiation skills. They made me the offer, $22,000 a year, $2,000 sign-on bonus, and I immediately accepted with no negotiations at all. And that kind of started the career. It's kind of interesting. I mentioned Susan Barber, Susan Merrill. Her and her husband are the founders of a very successful faith-based not-for-profit called Family First, that some of you may have seen. Tony Dungy is the primary spokesperson, and a lot of NFL and other athletes are involved in their very large nationwide not-for-profit. And Taryn Few, now Taryn McKay, for any of you football fans out there, her husband is Rich McKay, the president of the Atlanta Falcons, who used to be the general manager of the Tampa Bay Buccaneers, and his dad was the original head football coach of the Buccaneers. So, and I'm still good friends with all of those folks. But kind of a crazy way to get into the banking business, and I still kind of scratch my head here. What is it? I guess 21 years later, so still kind of scratching my head out how I got into this business. I do want to maybe take a little bit different approach today to just talking necessarily about Raymond James and what we do day in, day out. And before I kind of give you the framework for what I thought would be hopefully of interest to you in terms of how do we think the way bankers think, and how do we go about conducting our business. And I think that maybe over the last 20 plus years, maybe I've learned a few things that I've certainly apply day in, day out into decision making and how we run our company now. But just a real quick background on Raymond James, and also a little bit of a commercial, if you will. I know that many folks in here are familiar with Raymond James, but I went to work for them 5 years ago, just had my 5-year anniversary with the company last week. Raymond James is the largest financial services firm based in Florida. Started in the early 1960s by, which is a little bit unique, by our current chairman's father, Bob James, who passed away in the early 80s, ironically enough, right before the company went public in 1983. Tom James, our current chairman, has been in that role since 1969. And as I mentioned, we're a public company, Fortune 1000, about a $4 billion market cap. We have about 40% inside ownership of the family members and employees. We have an ESOP and a lot of inside ownership. So although we're a large publicly traded company with all the normal corporate governance, it's still in a lot of ways run a little bit like a family enterprise. And that has its own set of challenges, but I think it also presents some unique opportunities and a very entrepreneurial approach to the business. Just real quickly in terms of what our business is comprised of, our primary business is retail, what we call private client group, retail brokerage business. We have about 5,000 financial advisors in all 50 states. What's a little bit unique is about 75% of those financial advisors are actually independent contractors. They actually are not employed by Raymond James. They own their own businesses. They're responsible for their own office space, whether it be they own their building or rent office space. Once again, part of that entrepreneurial culture, these folks, in the fact that they actually own their own businesses, are very independent-minded, very service-oriented. That we're really there to service them and their clients. They get a higher payout percentage. Those financial advisors get probably something in the neighborhood of 85% of the gross commissions and fees paid out to them, and we keep 15 to 20% versus the employee financial advisors get a payout kind of in the 40 to 45%, but we handle all the expenses, office and otherwise related. That's about 65% of the Raymond James organization. We have a very large capital markets business, a full-service investment banking business, primarily centered around 8 business units. We have a large energy practice. We have a large healthcare business, a large real estate investment banking business, consumer product, and also telecommunications, along with depository institutions. We do a lot of institutional business with banks and other broker-dealers all over the country. We have a large fixed income business, sales and trading, public finance. We do a lot of business with a lot of governmental entities, municipalities all over the country as well. We have an asset management business where we manage high net worth client and institutional investments for large institutional investors, not only for Raymond James, but we have a mutual fund family under the brand Eagle that is offered up on a variety of other platforms, Wells Fargo Advisors, Bank of America Merrill Lynch, UBS, other platforms market the Eagle mutual fund family. And then the last large business, if you will, is Raymond James Bank, and I'll tell you a little bit about what we do. It's a little bit unique. We're actually the second largest bank based in Florida, but you probably hardly would know that we have a bank because we only have one office. And I told some folks earlier we do have 2 ATMs. They're both on the campus at Raymond James, but we're really not a traditional retail brick and mortar bank. We are there really to help support the clients of Raymond James. We have our deposits are a little bit unique in that most every client's brokerage account has a fair amount of cash balances in it, a few percentage points anyway. That cash is aggregated up each night and is swept over to Raymond James Bank into an FDIC-insured money market that are the funds that we use to deploy into the loans and make a spread on that business. So once again, a little bit unique. We're about $7.5 billion in assets. We have about a third of the firm's capital invested in the bank subsidiary, but we really are here to kind of work with the other businesses inside the Raymond James organization. Any quick comments or questions on Raymond James before we kind of dive into maybe some lifelong lessons and some things on why do bankers act the way they do and think the way they do, and some.
One thing I think is very interesting that maybe you might elaborate on is that one feature that is unique to your book of businesses is that these are very, very large commercial loans.
Yeah.
So it's a Sydney big
Yeah.
commercial lending.
Yeah.
But talk a little bit about maybe even some real life examples of how you would be talking to the investment bankers in these other areas and how this symbiotic relationship works between them banking the customer in terms of M&A or advisory
Yep.
work and you lending to them.
Absolutely, that's a great question, and our business is extremely synergistic with our capital markets business and vice versa. I mean, when I say that, we're very much in a growth mode. We're trying to grow the bank's balance sheet, make spread on what we perceive to be good credit decisions, and at the same time, we can provide, and it's almost mandated in some cases, that we provide balance sheet support to the investment banking clients and institutional clients of the firm. So, real life example, we're in the middle of some deals right now where, actually there's two things in our pipeline right now where these are privately held companies contemplating an IPO. They're working with our investment bank, and it's, as you can imagine, that's a very lucrative fee opportunity. It's highly competitive. We're competing with all the quote-unquote big guys. And in order to play any role of any substance in terms of generating reasonable economics to our firm, we are going to have to be a balance sheet provider. We're going to have to play a role in providing credit to the company, either a term loan or their revolving line of credit, as just part of that's kind of they got to check the box that you're playing a role. And it's interesting, I shared with some folks earlier, you may have heard of the anti-tying or tying laws and rules. Actually, I don't know how long ago, maybe 30 years ago, it used to be that a bank and an investment bank could go in and say, we will provide you this loan, but you have to use our investment bank to handle the underwriting for your offering. Well, that's the kind of stuff you at least get thrown out of the business, if not thrown into jail for. There's actually very strict laws and rules against tying investment banking to providing loans. That being said, the reality is it happens every single day. It's just not in writing. Companies, CFOs and CEOs are demanding the banks that are going to play in their underwriting for their offering or M&A advisory work is going to be providing credit support to their company, because invariably these companies have some level of leverage almost in every situation, whether it be some at least line of credit support, or in some cases if it's a acquisition, usually there's some slug of term loan, senior bank loan that's supported by mezzanine, and then usually ultimately with hard equity from a sponsor or something along those lines. So it's very much mandated and necessary that for us, and as Raymond James has grown, we're trying to move. We just did our first deal left lead of Goldman Sachs. It was the first time that we've ever been left of Goldman, and it was a situation where the bank had to be supportive of that effort in terms of us providing credit support for them. So that dynamic is alive and well, and I live it every day, as do our bankers.
Which is sort of how I understood it, that dynamic is still there, that the services are offered at the same time. But compared to when it was struck down, the financial services firms had the bargaining power and sort of insisted on that,
yes.
Whereas now the
Yes.
companies have
the
bargaining
companies have
power
that.
and say,
That's
"We're
right.
not going to
That's
give you
right.
banking business unless you have your balance sheet behind you."
Absolutely, that's definitely the case. That there are, it's a highly competitive business. There are plenty of banks and investment banks that are willing to step up and provide that level of balance sheet support. But clearly the power is definitely now more in the C-suite, the CEO and CFO of the underlying company. Yes?
Underwriting is one of the businesses that you're participating
Yep.
in. And you also mentioned that a large portion of the investment bank's business is through retail. I was curious how it's typically distributed between retail and institutional investors when you do initial public offerings.
Yeah, that's a good question. I hope everybody heard in terms of an underwriting of an offering, how much of it goes retail versus institutional. It's very specific to the industry. There are a couple of industries that go a lot more to retail, and that's the REITs, that's the Real Estate Investment Trust, that tend to be more of an income-oriented investor. The institutional investors, there's a handful of large institutional investors that buy REITs, but that's a very retail-oriented product, as well as there's an energy structure in the energy space called MLP, or Master Limited Partnership, that's very income-oriented. That tends to be more retail. Absent those two, and we have a very large retail distribution, and that's one of the things that one of our competitive advantages over some of our competitors. We have a very large retail distribution. The reality is, for a lot of these smaller IPOs that tend to be riskier transactions, that tends to be more institutionally focused. I would say, in general, as a rule, is probably 90-10 institutional versus retail. So, any other quick questions? And well, I've got enough time afterwards. We can answer any questions specific about Raymond James or anything else that we talk about. But feel free to interject with questions or any observations that you'd like to. Why do bankers think the way we do? And who in here has actually gone to a bank before and been turned down for a loan? I know I was in that camp. I'm sure. Don't be reluctant to raise your hand. I mean, it's like, why would a bank turn me down when I'm going to tell them I'm going to pay? By the way, I'm just curious. I'd love to see get some feedback. What do you think a bank's approximate margin is? When I say margin on its assets, what do you think that banks would typically make just on a spread basis on its assets? That would be its assets over its liabilities. What would you say on a percentage basis? Anybody fair want to throw out any guesses? Is it 50%? Is it 20%? Is it 15%? What is it? 1%? What? Anybody have any guess? I heard 7. Anybody have anything else? 6. Anybody have any other guesses? Yeah, but you're kind of cheating, right? I mean, you've kind of done that, right? Yeah, I would say in general. I mean, it varies a little bit, but it's probably in the. This is a broad range, 2.5 to 4.5. So I'd say your 4 is right in there. So our margin the last call it 3 years or so has kind of been 350 basis points. So 3.5% on our assets. So does anybody know how is it that we can make? Would you invest in a business that only makes 3.5% on its assets? You probably wouldn't invest. How do we generate an acceptable return then? Well, volume's one thing. Anybody? How would we generate? If you generate 3.5%, does anybody in here want to invest in a company that's going to generate a 3.5% return? How would we generate a higher return? Leverage, right? Banks are inherently highly levered. Okay, just a general rule back of the thumb is about 10 to 1. Okay, so for every dollar of assets, we have about 10 cents of equity and about 90 cents of deposits or liabilities. Okay, so we inherently have a lot of financial risk in our model. Just inherently, that's what we do, and I'm sure that we've got a lot of finance professionals in here and folks that are going through these schools. I'm sure that you've been told. I know I was told on 100 occasions, you do not want to have a risky operating strategy and a risky financing strategy, right? Has anybody heard that? Well, that's why banks tend to have a very low risk profile to what their underlying loan portfolio. Now, we're all involved in riskier businesses to a certain extent, but our core business, our core loan business, tends to be a low risk asset because we are inherently levered, and you know if you make some mistakes, you've only got about 10% cushion of equity. And we'll talk about the regulatory environment. When I know everybody in here knows that the regulators want more and more capital and less leverage and more capital. And clearly the industry has moved in that direction, which is a very important dynamic because it has the implications of lowering returns on equity and potentially lowering investors' appetite to put money into this space because of that dynamic. Held to maturity, mark to market, just a real quick accounting exercise for everybody in here. Everybody in here has probably heard of mark to market, right? That's where you're every single day, the accounting treatment on your balance sheet is you're literally writing up and down your assets based on your estimate of what the market value of those assets is. And I say estimate because in some cases assets that are subject to market are very, very illiquid, obscure assets, very, very difficult to find a market value for, versus a publicly traded equity that it's all agreed to, whatever the closing price of that stock was in that day, everybody's going to agree that we're going to mark to that market. Held to maturity is where the vast majority of bank loans as an asset class are held on a bank's balance sheet. And it's an important distinction to make because these are not mark to market. These are not written up and written down. These are actually in this accounting term called held to maturity, where they're actually on the balance sheet and reserves are set up against that asset, okay? You only would write the loan down if you don't believe you're going to get all the cash flows back in repayment of that loan. And so that's an important accounting distinction. And as a matter of fact, there's been a lot of discussion that's even ongoing, although it's now widely predicted that FASB, which is the governing board for the accounting profession, there's been some folks that have said we ought to market all the bank's balance sheets. And our industry has been adamantly opposed to that because of the extreme volatility that could potentially play out. I mean, just think about this: a loan on a commercial building in downtown Orlando is worth X, and that similar asset in Richmond, Virginia, is it worth the exact same thing? Is it worth 5% less, 8% more? I mean, it would be virtually impossible to mark a bank's loan portfolio to market, and yet there's still some investors out there, and even FASB, it's in the comment period right now, they're contemplating moving banks to market. Once again, we think that's going to fail. Reserves are expense day one. This is a crazy business from an accounting standpoint. The day we book a loan for $100. We are going to estimate over the life of that loan and loans like it what our losses are going to be on loans that look like that, okay? And let's just, for the sake of argument, I would say our commercial loans in general, we probably have about a 1.5% loss forecast into our underwriting. So on that $100 loan we make today, we write off an expense $1.50 before we make any money on the loan. So we actually have to earn enough interest over the life of, for the beginning of the loan actually to make up actually what we expensed on day one. So as you're growing loans, you're actually having a hard time outrunning your expenses on reserves. Once again, it's actually hitting your P&L. You're setting up this balance sheet reserve that hopefully won't actually materialize. Hopefully you'll collect more, but the reality is and there's always this challenge with the auditors. The auditors do not want your reserves to be, they really want it to be exactly what you think it's going to be. There's really, if a conservative management team would want to have what they perceive to be conservative reserves, or therefore more reserves than what's actually going to be wound up hitting once you go through the collection period on the loan. But that's an important dynamic in that as you're growing loans, as you're booking a new loan, you're actually, it takes a while to actually earn enough to generate more than what you reserved against the loan. Matching funding sources, the liabilities with the loans or the assets. That's an incredibly complicated and also very risky part of the banking business. There are a lot of folks that are running into a lot of problems. You could think about this, particularly in a rate environment right now where we've come in from record low rate environment where you could potentially be funding long-term loans that have a fixed rate component for 5, 10, 15, even a 30-year mortgage loan. Would you want to fund that 30-year mortgage loan that, by the way, has an average life of about 12 years with floating rate deposits that are subject to change daily, and we're in an incredibly low rate environment right now? You could make, we're going back to our spread, you could probably make 550 basis points of spread today, but over time, what is the risk that rates are going to increase and you still have this fixed rate asset? So that's a terribly challenging dynamic that our business has to face, and we try to create liabilities that are with equal duration and maturities as our assets, and also do some hedging as well. I mean, there's some hedging techniques that we can do, but those are very important as a backdrop to how decisions are made. Yep.
So I'm very sympathetic to the position, but also the accounting treatment, current accounting treatment of held to maturity, widely publicized and thought of in the commercial real estate space in particular, is that banks will extend the maturities of loans for customers that they don't think can really pay it back, in part because they don't want to mark, they don't want to have, if they do write the loan down. In your, not necessarily with your book, but in commercial lending, have you seen a lot of that kind of behavior? I think that's mostly in the real estate.
No, I think that happens every day. That where loan maturities are being extended. What's the dynamic that's at play? You wouldn't care as an investor that it's not mark to market, that it's in held to maturity, if you felt like the management team, if you're the investor, if the management team was actually properly reserving for that loan. I.e., it's kind of another way of thinking about marking the loan. That's the most fascinating part about this business. You and I could be in the exact same loan or in similar loans, and you could be reserving one way, and I could be reserving under a totally different methodology, and that's totally acceptable in the accounting standards in the regulatory environment based on our experience level and things like that. So it's very interesting that that institutions have that they're allowed that level of flexibility in terms of how they're reserving against their assets based on what they perceive to be the collectability of the loan, to be what the underlying collateral is. And so, that's an important distinction. But that's a big driver too. I mean, that's really fundamental to the issue that banks have been facing, and even at this day, despite the fact that the stock market and the equity market has rallied quite a bit, there are a lot of smaller institutions and even some large ones that there's a perception that they still have more loans to write down, more pain to take, that they have not properly marked their book. That's why you have some institutions actually trading below book value. If you see that, then the investor community is saying that this institution has not properly marked the assets down, and they're going to have to mark them down in future periods. I mentioned the margin, the 350% or so, call it 3 to 4%. Some of these accounting rules. Once again, it's a crazy business, but it's one where, we all joke around about the weatherman, that how they can keep their job and they're wrong a significant portion of the time. In general, and this may be an oversimplification, but I know it's directionally correct, it's a tough business when out of every 100 decisions you make, you got to be right 99 times out of 100. That's a tough business. But at the end of the day, because on a gross basis, we're starting with 3.5%, let's say, okay, and then we have our expenses, and by the time we get through all the expenses, if you're wrong more than one time out of 100, you're not going to make money. You're not going to be profitable, and so knowing that you got to be right that many times out of 100 in this model where you've got relatively low spreads, 3.5% with a lot of leverage in the financial model, that is a driver of how you're going to make your decisions, and therefore you're probably going to wind up passing on some good opportunities and foregoing those good opportunities in lieu of not wanting to make some errors. And I know it's funny. It's kind of somewhat come full circle. Everybody here has, I'm sure, been to an Outback Steakhouse and Carrabba's and that whole family of companies that's actually based in Tampa. I remember Outback started in Tampa in 1988. They opened their first restaurant. Actually, it's just a very close to my home now. I remember leaving a client call, and I had been at the University of Florida for about a year, and I was with my boss, and we had visited with the founders of Outback Steakhouse. And most folks in the room are too young to remember the Crocodile Dundee movies, but you may have seen them. And he had this whole Australian theme, and that seemed to be kind of the cool thing for the moment. And I remember leaving this appointment. And these guys had one restaurant. It was successful, but then they had these big expansion plans. Private company at the time. They had some angel investors helping. They were trying to raise some debt capital to help them with their financing. I remember my boss and I leaving the call like, this Australian theme, Crocodile Dundee, this thing will be done inside of a year. So, and lo and behold, I certainly missed the boat on that one. And it's kind of funny because through a variety of different other circumstances, we ended up doing a lot of business with those guys. But our business is inherently fraught with those opportunities where there's going to be some successful situations like that you're going to pass on, but hopefully by virtue of needing to be right 99 times out of 100, there have been some other failures that I'm glad we passed on too. But that's always been the one that kind of stuck on my mind. It's like, what? Yeah. Yep. That's right. If it pays in full, that's right. Yeah.
Guys think of for a loan that you make, what would be the recovery? $60 something, something like that?
Yeah, that's a good question. What we'd call severities in I was sharing with some students earlier on our residential portfolio. We have a very large, and it's a bigger part of our business, is our commercial loan business. Our residential portfolio, our severities or our loss rates have been in the high 30s, maybe around 40%. So make a $100,000 loan, we're going to write off $40,000 of that loan balance. Remember, when that loan was made, we went into it thinking that there was additional equity above the loan amount. The commercial loans, it varies by industry. I would say that the real estate loans have probably a severity. It could be 30 to 40% severities, loss rates, and commercial loans. C&I commercial and industrial loans, it once again depends on the industry, but those severities could range from 10 to 50 or 60%. So it doesn't take many mistakes. It does not take that many mistakes to wipe away a lot of profits, and that's why in our business the decision making and the criteria by which you're underwriting the loan is paramount to your success.
You guys look not so foolish, right? So,
Yeah.
So, I mean, the fact that Outback Steakhouse is everywhere now,
Yeah.
really, in your situation, wouldn't have made any difference anyway, right? I mean, they would have just paid it back. In fact, they could pay it back 100 times.
Right.
It's irrelevant.
Right.
And
We would have made our 3.5%. Right. Yeah.
You would have been a good friend and got to do 2 more deals.
Right. Yeah. Right. Yeah.
So, are there situations where, or is this not allowed under regulations? You never have any equity position or any convertible
Right.
opportunities?
Yeah. There are certain situations. There are certain situations where, typically not. Typically, in most banks, the lending business is kind of separate and distinct from. You may have a subsidiary or an operation that does mezzanine that takes an equity stake. We've had some workout situations where we've resulted in an equity stake in the company or some type of mezz arrangement, but typically going in, we're playing in the senior bank loan space where our upside is collecting the loan and generating our net interest margin. That is our upside. So that's an important distinction to make. Wanted to talk a little bit about the regulatory environment that we're facing in general, and I've got up here what you may or may not have heard of before, but there are what are called the CAMELS ratings, which are these various categories that the regulators come in on an annual basis, and every depository institution in the country is required to get an annual exam, and this is our scorecard by the regulators each year. And you're rated in these 6 categories, and then you're also given what they call a composite rating, which is in effect the aggregate of these six ratings. And you're rated 1 through 5, 1 being the best, 5 being the worst. And if you're, at the end of the day, if your composite rating is a 1 or a 2, you're in good shape. If you're 3, you're kind of on the watch list, not really in great shape. You're probably going to be precluded from any other activities. You couldn't do a lot of expansion. You couldn't make an acquisition. If you're a 4 or 5, you're really in bad shape. And if you're a 5, you're probably not going to survive in this environment. So I wanted to just at least have everybody in here see what it's kind of this kind of an interesting acronym, this CAMELS ratings, and then they go through and rate these various categories. The bank regulatory environment has gotten not hostile is not the right word, but as everybody knows, there's been just a dramatic increase in the last couple of years in bank failures. The regulators have been painted with a brush that they kind of let the party go on too long, that they were asleep at the wheel, that some of these failed institutions, they should have picked up on some of their practices and should have been able to predict what was going on. And as a result of that environment, it's just an increasingly challenging environment. And the regulators' answer to everything is that they want more reserves, i.e., write down your loans, and they want more capital. That's kind of their answer to everything: is put more capital throw more capital at this business, which sounds fine, except that at the same time, this industry wants to attract more capital to it, and if you're an investor and you know that there's even more capital that's going to be required, it's going to depress your returns and obviously your valuation metric as well. So, this regulatory environment, we're actually in the middle of our examination right now, so we'll be spending time with them for the better part of 8 weeks or so. It's almost kind of a full-time job when they're on site going through various loans, these categories, making sure that your asset quality is sufficient, and that your earnings and your liquidity sensitivity. By the way, is this whole interest rate sensitivity we talked about earlier, the matching of your liabilities and your assets that's gotten a lot of institutions in trouble over the years. So I wanted everybody to see kind of that general framework. Clearly one of the issues that arose in the mortgage business was a confluence of a variety of different factors, but you had we all know that there were folks getting loans that had no ability to repay the loan, that these institutions that were originating the loan and ultimately selling the loans and distributing the loans were making fees along the way. They didn't really have any balance sheet or risk in they didn't have any balance sheet at risk. So, and the other thing was you had this long history of an asset class always increasing, at least nominally, and in some cases, home prices were increasing dramatically in some markets over a long period of time. So, I'm curious, which one of these assets would you want to invest in? And there's no right or wrong answer. I just, it's always interesting. You've got, time on the horizontal axis here, and you never know really where you are in that horizon, right? I mean, we've all seen. You could look back. You could be at time zero right now and look historically at what prices have done, right? And I would obviously home prices over the last, let's call it 36 months, are down on the bottom, right? Would now be a good time to buy a house or make a loan against a house? I mean, prices have been falling, right? Once again, I'm asking somewhat of a rhetorical question because I don't know. At some point, we're going to look back. You're going to look back at time zero, and we may have some more room to go. But I think we all would agree that over an extended time horizon, home prices are probably likely to rise. So, that's one of the issues that was in the mortgage business was it was the top right slide that we were all lending into, and even the rating agencies in their model when they were rating these securities, I think they had embedded in their model as kind of their base case was this asset class is going to increase indefinitely at like 4 or 5%. I think that was like their base case. That was obviously very inaccurate. I mention this because, and this is important no matter what business you go into, whether it's somewhere where you're providing capital, loans, whether you're making investments. It's terribly hard to buck the trend, and where everybody is making money and times are good is probably the time you ought to be jumping off the bandwagon and leaving the party, right? And once again, I haven't been doing this, for 50 years, but I've been doing it for 20 plus years, and I know I've been guilty on at least 2 or 3 occasions of not wanting to leave the party at 10 o'clock when I knew it was just cranking up and we were going to go to 3 a.m., right? That you've got to have the discipline and have the foresight to know that you may be leaving a space that's still got some more upside, whether it be an investor or a bank, and going the other direction, and vice versa. There are buyers right now of declining assets. There are institutional buyers right now buying raw land in Florida, probably what's deemed to be kind of the kryptonite of all investments right now, because you've got to be able to have a 10 or 15 year time horizon to buy raw land in Florida right now. Just given the inventory supply demand dynamic, there's not going to be a whole lot of new lots being developed into residential development. So. Talking about smart and strategic thinking, believe it or not, we actually use the Porter model at work. I know you guys can't believe that, but you actually will use this, and it's an incredible framework. And for you to just kind of boil it down to the basics, who's the competition? What is you ought to be asking this not only for your business, but if it's in a business where you're providing capital, if some of you guys and ladies are getting into the investment management business and you're trying to pick and choose between various asset classes or individual assets in the asset classes, you better do this work. You got to know what the landscape, the competition is, who are the suppliers, what is their competitive advantage, what are the substitute products, what are the barriers to entry, and you've got you use the skills that you've learned here to make those critical decisions, because don't let the other folks do your homework for you. That's of critical importance. Your own homework is actually where you're adding the alpha to the equation. do not rely on experts. I can assure you, your own work and your own due diligence is probably going to be way more valuable than the quote-unquote experts, and clearly more, we all, and myself included, were guilty of being too reliant on third-party rating agencies, research departments, equity research. Do your own homework, do your own due diligence. It's amazing as I can't believe that and I'm sure that you still probably are intrigued by and study Warren Buffett, who we studied when I was in school here in the 80s, and it's tried and true. You know what he does? He reads the 10K. It's like, it's amazing to me how he does his own homework. Also, the world is becoming increasingly specialized. Generalists in most businesses are going to go the way of the dinosaur. So to the extent that in specialization and having deep knowledge on your business and whatever industry you're in is paramount. And that's not to say that you can't make a shift over time, but everybody's business is just becoming increasingly specialized, and to the extent that that you know that space intimately, no matter what business you wind up going into, is going to be increasingly important. Want to talk a little bit about information sources, and I know that everybody in here is probably a lot more proficient at gathering data than I am. But you've got to come up with your own process for getting good information. I think we're almost guilty as a society for having too much information, and it's tough to sort through the stuff that's quality and what's relevant. But develop your own plan over time of what's relevant for whatever business endeavor you're going into. The specialized industry information is of critical importance. I would highly recommend, and regardless of whatever business you go into, read at least one business or leadership book per quarter. And I know we probably have some voracious readers in here that read much more than that, and you probably got your fiction that you like to read. But find a business book or a leadership book or something that you can actually apply in your professional life at least once a quarter. I find that there's always great lessons that are in there that you can put into your business life. Yep. Yep.
So, I guess in addition to, it's somewhat true for an equity analyst as well, but certainly for you, knowing those things is useful, but you have to put yourself through a whole bunch of what ifs, right? Because you're lending to somebody who has earnings today,
right,
that can pay the loan back. And so you have to go through a lot of mental work to walk through all the what if scenarios, right? Because it's something that hasn't happened today.
Yeah, what would impair their ability?
Exactly.
What scenario would impair their ability to repay, right? Yeah. Absolutely. Under what scenario, and how do you try to model that out? But what assumptions are relevant for that exercise? I know probably everybody in here reads the online version if you're reading it. The Wall Street Journal, the left side, or the online highlights. You've got to do that every day, because you've got to be conversant in a certain level of topics. I think that will serve you well over time. I've mentioned on here just a handful of economic and financial metrics that are just key no matter what business you go into. You've got to know a handful of things. If you don't know them daily, at least weekly. The steepness of the yield curve. What's the difference between 2s and 10s right now? The 10-year Treasury and the 2-year Treasury. Fed funds or mortgage rates. You want to know the approximate what's going on in terms of the interest rate environment. What's going on approximately with mortgage rates, because it drives a lot of things. Price of oil. S&P index or the Dow. GDP, unemployment rate. Some things that are kind of general economic. Some general economic key indicators, and then some just basic exchange rate, yen, dollar, dollar, euro, maybe some others, because that kind of is a great indicator of where capital flows are going. I mean, once again, regardless of what business you go into, these are just a few that you probably want to develop a methodology for getting them at least periodically and kind of knowing what's going on with those indices. And there's probably others that may be much more important or relevant for your business. I want to talk a little bit about dealing with people and their how they go about conducting themselves. And I'm just curious, taking a show of hands here, who in here would just say people inherently are good versus bad? Who thinks people in here are inherently good? And who in here thinks people are inherently bad? So a low percentage thinks people are bad. So not to get too biblical on you here, but I thought that this was interesting. You've got two things that sound maybe a little bit in conflict with each other. That one in Psalm and one in John. I wanted to share a couple of scenarios with you, and hopefully get your honest and candid feedback on what you would do if you were put in this situation. You run an investment fund that has $200 million invested in a variety of different assets, and of that $200 million, you're a rich person. You've got $50 million of your own money invested in that fund, plus you have another $50 million outside of that fund that's your play money and other things, other investments outside the fund. And then you have $150 million of outside money, institutional investors, wealthy investors, family, friends that are investing alongside of you. You find out one day that one of the investments that your fund has made turned out to be a fraud, and is going to result in a $5 million loss to the fund. What would you do? Would you let the fund take the fund probably has an agreement in it that says, any gains get shared pro rata with the fund members, and any losses get shared pro rata with all of the investors. Would you let the fund take the loss pro rata to all the investors, or would you, based on your own financial wherewithal, would you personally take the loss of $5 million and make the fund whole? What would I'd love to have a volunteer. What would you do? Yes.
Happy.
Okay.
I would do the opposite, actually, because all the investors knew going into it this was the risk that they were going to have, and as long as you weren't part of that fraud or whatever,
right?
You weren't the one that was directly, having to write off this $5 million. So everybody knew the risk going into it. As long as you gave it your full faith, your effort, then I think it should be distributed.
Yeah. Okay.
I would take a loss to make the fund whole, because if I'm running the funds and inherently my mistake, there's something that I could have done, if there wasn't something that I could have done, then it's just to show good faith to my investors, and hopefully in the long run we'll bring in more.
Yeah. Okay. Yeah.
But I didn't get rich by taking losses like that, so I just think it'd be better business practice. This kind of stuff happens in business. You can't always tell if there's fraud. So as long as you get the due diligence, and you try, it's what happens. It's part of business.
Anybody else? Yes.
Do you think it makes a difference if the fund is like a bond fund that has more volatility versus, say, an international fund that has extremely high volatility?
I think that may make a difference, perhaps, but all the investors signed up and said that and I don't want to necessarily complicate the scenario by that, but all the investors signed a document saying we all are in for gains and losses, right? So, but yeah, go ahead.
I was just going to say that if you had to write it off, aren't you taking that money from some other person?
Well, in this case, if this person running this fund made it whole, in effect, they would replace that fraud with their own, the outside 50 that they've got. They would bring it would bring that in. Okay, so anybody else have any comment, or what would they do? What would you do? Yeah, this is a private investment.
Well, then, I mean, I would imagine it's probably going to cost me more if there's a fraud in my funds and now I can't raise new capital and some of my investors leave. So if it's legal and I can do it, then I would go ahead.
That's a good point. I heard that raised. How is this going to impact the ability of the fund going forward? $5 million is a lot of money. That's a lot, right?
It's not a big deal if I think it's going to be more than 10%.
What if it was a $30 million fraud and you have $50 million outstanding?
Mm-hmm.
At what point would you see it?
It depends on how much I think my fund is worth. If it's worth my fund is shutting down, then I can go open a new one under a new name and potentially have a greater return and use my $50 million as seed money there. That might be worth it.
Yeah. By the way, there's no right or wrong answer necessarily in this case.
Taking the loss and making the whole fund was the widely known answer to this question. When you have less people taking the risk of actually creating value, and because you have less upside and more downside, because if you make a $30 million profit, you're not going to pocket that whole thing either, or a $5 million profit. So in essence, if you make money, you split it. If you lose money, you take it whole, or you make it whole. It just doesn't make financial sense. So.
Okay. All right. How about another scenario? You're a prominent real estate investor. Oh, I'm sorry. What would you do? We're gonna go back and I'll tell you. I'm not going to tell you what I would have done. I'm going to tell you what happened. You're a prominent real estate investor. You have an impeccable track record, 30 years. You've accumulated a net worth of $175 million. You got $30 million liquid. You have a great reputation, borrowed a lot of money over many years from a bunch of banks. However, real estate values start to plummet. And now a few of your projects are worth less than the loans extended on it. You find out that despite the fact that you guarantee the loan personally, everybody understands that, right? Most privately held companies that borrow money, the principals personally guarantee the loan, so that means the bank, the lending institution, not only can go against the borrowing entity and the collateral, but they can also sue and go against the individual personally. In this situation, that despite the fact that this person personally guaranteed the loan, he finds out that there were some documentation errors and that the guarantee is probably not enforceable, that it would be tenuous at best if the bank would win in court to sue under the guarantee. What would you do? Would you personally, or pay the loan off personally anyway, despite the fact that if you went to court, you probably could avoid paying? Or would you walk away from the project altogether and the loan and let the bank resolve the loan with its collateral? Yes?
Can't you let your loan get behind on the payments and renegotiate with the bank?
To the extent that they are willing to negotiate, yes. But in some cases, they will. If you were not willing to sign again the guarantee, they'd probably say no. We'll go take the collateral. Right? That's another option that a lender has. They don't have to extend the loan at the maturity date. They can call the loan due and then go sue the borrower, and go against foreclose the property, take over ownership of the property. So in this case, what would you do?
Promise, and if you expect to do business with them in the future, you're going to have either a gold star or a black star in your application.
Yep. Anybody else?
Retire after 30 years, and you could probably just get away with walking away and not having to pay it. However,
absolutely.
then, you know, there is something to be said for what your reputation is worth, which I personally think is probably, in this case, more than what you're going to have to pay off for that loan. So I just guarantee it.
Okay. Anybody have any?
Well, this is exactly what happened in our housing market, and I think the answer is that most people chose the route to let it go.
Yeah, just walk away, right?
But like you said at lunch, I mean, if it's worth 100,000 and you owe 110,000, maybe you choose to stay. If it's worth 100 and you owe 400, walk away.
Well, in this case, let's say just putting some dollars around it. Let's say the loss was going to be if you wrote it off. If you were to pay the loan off, let's say it was $10 million. So you'd have to take $10 million of your $30 million in liquid assets and pay the loan off. Yes.
I was just going to say, going back to what I was saying before, I think the bank is going to be more willing to renegotiate a loan because they're just going to have that asset sitting on the books anyway. They're not going to be able to sell it, given, you know, like you said, that's pretty much what happened to our current market. They're not going to take
what if the borrower says, I'm not. Here's the property. Here's the deed to the property. There is nothing to renew. You now can either sue me under this guarantee that I think is probably not enforceable because of some loopholes and some documentation errors. So there is no loan to negotiate in this scenario.
Well, I think that's, like I said, just walking away from the project. If you're trying to argue that people are inherently good and they want to keep their keep their stake in this.
I'm not arguing that people are good.
It's your call. You know, you made this promise. You have to, keep your stake in it. I think that's something. I mean, I know that this happens all the time. People will let their loans expire just so that they can renegotiate it because it's like illegal to do it now. Banks have to tell you, well, call us back in a few months after you've missed a few payments. So, and I think, like I said, it'd be in the better interest of the bank and the person if they are inherently good to renegotiate that term.
What if they're not inherently good? What if they're like, I want to get out of this? They're underwater in the property, right? They owe let's say they owe $10 million and it's worth $2 million.
Like I said, I'm not answering the question. I'm just offering an other.
I know you're not answering.
Yes. To me, I think it depends what kind of shape their other projects are in. If they owe maybe 50 or 60 on that and they only have 30 in liquid assets, then they might have to walk away from this one. But if those other projects aren't too bad, then maybe they would stay.
What if they had other loans and they were in general okay, they were current and cash flowing? What would you do?
It's tough.
Okay. Anybody have any other comments or thoughts? Or I share these with you just because, and these are two of a long list that I could have picked from, and I don't really have the right answer per se. It's amazing how money impacts people. I don't know if necessarily people are good or bad. I'm still kind of on the journey to figure that out myself. I will tell you that it goes without saying, once again, regardless of what business you go into, everybody in this room is going to wind up with some business dealings and people that you're going to do business with, and it is of the utmost importance. It's more important than anything else. It's more important than any model you can build, knowing the people that you're doing business with, regardless of what the business transaction is. And even despite that, I would share with you that some folks that have an impeccable track record, when things are all rosy, it's easy, But when things are challenging and there's money involved, at least that's been my experience, that you find out what people are really all about. Incidentally, just if you want to know kind of what has happened in this situation, and these have been clients of mine over the years. So and these all occurred at various time frames. But the individual that runs runs this fund made the fund whole. and that was how he felt. Number one, it was his reputation, it was his and his team's error on investing in a fraud, and that it was mentioned earlier, his ability to keep the fund open and hopefully attract capital to the fund going forward was probably an important element in that decision. And then in this situation, the principal behind the project walked the project and threw the keys across the table. Once again, two totally opposite extremes. I just mention it because everybody in here is going to wind up most likely in some type of business transactions, and you need to minimize this, but you're going to wind up doing business with folks that do things that really surprise you after the fact. You will have those. You'll have some very rewarding and successful business relationships and friendships where people do not only what they say they're going to do, but they're going to take the high road at every turn. So, very important examples as illustrations of things that everybody in here is going to be facing. I wanted to close just with a couple of just general, I call them good rules to live by, and there are a million more, and a lot of these are not novel. I certainly didn't create them, but I looking back on the 20 plus years of my professional life, some things that have so far to date served me well. The day where your manager is going to be mapping out your career for you are over. I know, hopefully I'm stating the obvious. It's up to you to manage your own path, whether that be within the framework of your own company or more broadly than that. You need to take charge of that, and what that is going to entail is developing your network. Even if you work for a small company with 5 employees and it's a very entrepreneurial environment, broaden your network of folks inside your industry and outside of that, and always be open to new challenges and new opportunities. And that's not to say that I'm endorsing anything other than very strong loyalty to whoever your employer is. But by all means, the world has certainly changed, and we all know that really almost without exception, if things change inside your company, your job could potentially be impacted. So it's important for you to just be very proactive in how you're managing it. Stay close to where the revenue is produced. And that's not to say that you can't go off and take projects, and some of you may wind up spending the bulk of your career in places that are not necessarily immediately client-facing or immediately revenue-producing, but to the extent that you can stay closer to that, you're going to wind up making yourself more valuable to the organization. I know I have made the mistake on many occasions of, quote-unquote, promoting the best producer to manager. And those two things are not always, that does not always turn out to be the best result. As a matter of fact, some of the best producers that I've worked with kind of tend to be the Lone Rangers, tend to be the folks that maybe have the bigger ego in the room, and they have a hard time, working with and living with and working with and managing folks that maybe does things in a different fashion, maybe not up to the same standard in a variety of different ways. So always be cognizant of that. Spend as much time with clients, it's kind of the revenue, and spend as much time with clients as possible. It's very easy in this day and age for us to find ourselves, in our offices, in our work areas, and not spending as much time developing new opportunities with clients. Any of you, once you get your into a management role, if that's the path you wind up choosing, and this is so easy to fall into this trap that you wind up spending more time with your finance partner than your HR partner. Don't do that. You ought to spend more time on recruiting activities and coaching opportunities with your people with your HR partner at your side than your finance partner. And lastly, find some balance in your life. I have worked with a lot of workaholics, and they always, they always don't feel quite satisfied, and they also don't necessarily have a great grasp of everything else that's going on around them. So I find the best employees are the ones that have other interests, other things going on in their life. That's not to say that you can't work a significant number of hours, but I know folks that where work is kind of an all-consuming thing, and that's all they have going on in their life. So I know all of you Gators are, have a lot of diversity of interest. Everybody in here has got a lot in their life. So, yeah, I would say keep that as a point of reference going forward. Yeah. Any comments or questions? Okay.